YouTube so you can share it. Good morning, everybody, and welcome to the Mortgage Coach Tuesday interview. We have been doing this Tuesday interview for over 13 years. And Dan Rawitch has been doing the daily updates in the Mortgage Coach community for over 13 years. Isn't that cool, bro?
Woo, amazing.
Woo.
It's scary how fast time goes by.
It is. God, I knew it was more than 10 years, but I mean, it is just insane how fast time flies. So guys, today is about the mid-year forecast. We are almost at the halfway point of 2001. I think every loan officer in the Mortgage Coach community wants to hear from Dan on where are rates going to go over the next couple months. Where do we think we're going to land at the end of the year? Maybe some forecasting on where things will be in 2022. Also, Dan is going to give you some ideas and strategies on how to position yourself with real estate agents. So before I bring Dan on stage and hand it off to him, I want to remind you guys, this is a mastermind. Ask questions, put them down below. This will be live on YouTube. I know this is a call where a lot of people weren't able to listen to it, but you can forward it. So from YouTube, you can forward it to your friends, the mortgage friends that you have. If you're a leader or manager, you can do a sales meeting around this. So check that out. Also want to remind you guys that last week we made the Modern Real Estate Summit available to everyone. It goes for $99. You can just go to modernrealestatesummit.com, sign up for it. It will go up to $199 at the end of the month. And we want that to be a resource so that if you believe that I'm a coach and a leader to realtors, it's content, 3 minutes to 18-minute sessions from some of America's best realtors that you can use, whether it's on Zoom or in person, to be a leader, to bring advice and education to them. Also want to give you guys a heads up in the Mortgage Coach community that we did a press release today that we have launched a new superpower. It is the debt consolidation analysis. Now, for you Mortgage Coach nerds out there, it's been in there for several weeks, but enough of you have tested it, enough of you have pounded on it, and we also have some great success stories. So we're announcing it to the world. Please check out that press release, share it with your leadership team at your mortgage company. And if you do not know how to do a debt consolidation analysis, you need to, and we're powering that. So with that said, Dan, dude, as always, thank you, man, for I think over 20 years of friendship and over 13 years of creating content together, man. It's good to have you here.
Thanks, Dave. It's good to be here. I always love being with you, and you always make me feel special.
Yeah, well, that's because you are special, dude.
Oh, thank you.
Yeah, by the way, guys, if Dan is special and he's ever giving you some advice or some value, give this a like. Make sure you share it. Dan does it to create impact. Like, there's nothing this man loves more than like helping people win, helping people be more valuable to other people. And so if you do get value from Dan, please, he's a market mentor. He wants to be your mentor. It's one of his life's work is mentoring loan officers. So make sure you guys engage, make sure you pay attention, and make sure you take what you learned today and you put it into action. So Dan, jump on stage and give us your forecast.
All right, Dave, thank you. Do you mind if I share my screen?
Of course.
All right, let's do that real quick.
And we see it.
All right, good. So thanks for being here, everybody. I really appreciate it. I appreciate all of you. The support I get from this community is unbelievable. I won't go into it in too much depth right now, but a few years ago, I decided to leave corporate America and just the whole mortgage production world itself. There was no really strong reason other than, I was turning 60 and I'd been doing that for my whole life. And I realized my passion really is the markets. It's always been my passion. It never stopped being my passion. I never stopped trading. I never stopped studying charts. And I can't say that, over the last 30 years, I did it as any kind of competitive advantage, but I can say for sure that when I built RPM Mortgage back in '89 is when we started, it was my competitive advantage. And it's really corny. You have to picture me as a young, we'll call it confident and bold, perhaps cocky Dan, 30 years old or whatever. And I had left my bond trading job in Wall Street, and I just couldn't stop staring at charts even after I left. And I put an ad in Homes and Land. It was a full page. You remember when people did those ads? And yeah, I had all black lacquer furniture in my office. I had a black suit on with a dark power tie, and I'm leaning against my desk like, I'm the what. And the ad said, "From Wall Street to Main Street, we know." And I just started branding myself in the community as that, and it really worked, and it helped me recruit lots of LOs. When an LO would come into the office, I would show them my teller rate screen, which was very expensive at the time, and we found that LOs just were fascinated and wanted to learn how the bond market worked and how capital markets worked. And so my whole plan back then was to demystify all of that for people, and I never stopped loving it, and it never changed. And to bring the story to an end, I never thought about this being a business. And if it weren't for Dave and for Mortgage Coach, it wouldn't have been a business. And the way that Market Mentor has blossomed, and University of Options, it's just like every day I smile. I just think I do what I love, and it just seems to come to me. And so I just think sometimes when you add value and you do what you love, magic happens.
Dan, dude, you are seriously an inspiration. And I hope a lot of people get inspiration from just the consistency of what he's doing, finding out the part of the job that you love and being consistent at it. Clearly, if you want to be an advisor, giving a family a total cost analysis, the more consistent you are at it, one, the better you get at it, and two, the more fun your job is at. So dude, that is actually cool. And I knew that, but I hadn't really thought of it that way, man. You have literally been studying interest rates and putting them into a competitive advantage for yourself as an operator, and now as a leader for how many years is it?
For which part?
Just the whole time. I mean, the combination of operator.
Oh gosh, well, when I started RPM, that was 89. So
yeah,
over 30 years ago.
Yeah, and before that, you were a trader. And
that's what I did. Yeah, exactly. Trader or ran capital markets for a big savings bank.
So super special, guys. If you're new to the mortgage business, think about it. You got a guy who was an elite trader. He got into the mortgage space. He's been a CEO. He's been an executive. He's had every seat on the bus. If you're new in the business, make sure, one, you pay attention to everything that you learn here. Take good notes. Maybe even rewatch some of this. And I always tell people, like, you're new to the mortgage business, one of the first things you should do is start watching Dan's dailies. Like, you will, even if you didn't go to college and get a degree in economics and all of that, you watch Dan's morning updates for, I don't know, a month or two, you're going to know more about mortgages, interest rates, and the economy than people who got their degrees in economics and everything. I mean, like, literally just watch this guy and you'll be smarter than people that got their college degrees in this stuff. So dude, let's rock it out.
All right. Thanks, Dave. That was really appreciated. Okay. So I'm going to go through some slides, and I'll tell you the main theme here, just a spoiler alert, is to really talk about inflation, because unless you've been, sleeping under a rock, that the market's got inflationary concerns. There's a whole bunch of people that think inflation is going to get out of control and the Fed is going to have to raise rates. That same group of knuckleheads, just to share my position, they also think the economy is just going to rip roar and just go straight up. And while I wish the latter were true, I completely don't believe the former is true. So here, let's just go through some of these slides real quick. So this is core CPI. Now, CPI, as you know, is Consumer Price Index. And this goes back all the way to 1960. And you can see how bad it got from, if you look at these peaks in 70, 75, 80, and this makes it sort of easy for you to do. Go look at, especially these times here, look, because that was high inflation. Look and see what was happening in terms of Fed stimulus, what was happening with interest rates, et cetera. And what I think you'll find is there was really no stimulus going on. None of the things that today we say are inflationary, it was all the opposite back then. And if you look at the times where rates were very low, you're going to find that we see the same environment that we're seeing today. Yes, this is a spike. And I apologize because some of you listen to, a lot of the various things I do. And I know we have some Market Mentor members on this call. But the best way that I can explain what's happening with inflation right now is I compare the economy with your hunger. And I think about during the pandemic, we all got really hungry. And when you get really hungry, you'll eat almost anything and you'll eat too much of it. At least that's me. Worst place I could ever be, worst two places would be a buffet, Chinese buffet, which I love, or a grocery store shopping. You know, you're going to make bad decisions when you're too hungry. So the economy, the Americans got very hungry during the pandemic, and all of a sudden there was massive food being supplied, but it was not enough to solve this hunger. The hunger was so great because we hadn't eaten for a year. We were locked up. And then we're now sitting at the table and we're feeding our faces, and these food makers are going as fast as they can. They think of it as a restaurant. You know, the cook is just cooking because he knows there's a lobby, a lobby full of people, and they're all going to want to eat. And all of a sudden, you're not hungry. Oh my gosh, I'm full. And you push away from the table. Meanwhile, no one told the cook. He's like, oh my God, there's still people coming. And he doesn't realize everybody's actually starting to leave the restaurant. So think of us as consumers as the hunger, and the cooks, the food manufacturers, as the producers. And so what you have happening right now is you have this spike in inflation, which was essentially temporary starvation, hunger. And then you're going to see other areas where we have the spike in production costs, and you'll see a slide like that. But the bottom line, and this is Goldman Sachs. I got a couple of Goldman slides. I respect Goldman. There's things I don't respect about them, but they have an amazing group of analysts, and I find them to be amongst the most accurate. I tend to follow them the closest. So Goldman has continued to notch down their inflationary forecasts, and what you can see here is they're even seeing a dip coming sometime the end of 2021 going into 2022, where inflation, this is PCE. Now PCE, a lot of people don't understand even what it stands for. That is personal consumption expenditures. This is the stuff that we spend money on. It's kind of like CPI, but it's much more important, and it's really the Fed's primary thing that they look at. They just don't talk about it. They always talk about CPI, but trust me, they're looking at the PCE, the personal consumption expenditures, because consumption, what we consume, is 70% of the GDP. So this number just keeps getting forecast lower and lower and lower. And what you can see here, as you get down here toward beginning of 2022, we'll call it, you have inflation below where it was in 18-19. You have it similar to 16-17. You have it below where the Fed wants it. And then over the coming years, Goldman has it ticking up right exactly where the Fed wants it. So I personally think this is a little bit conservative. I think inflation is going to dip more than this, or I don't know that we'll have deflation, but that's the Fed's biggest problem. When you see him worried, or them worried about raising rates right now, they're not worried about inflation. They're worried about deflation, and deflation is the killer of all good things. Japan got into a deflationary period back in call it 1990 to 2000. It's been over 20 years. They call it the lost decades. And one of the reasons that this happened was very much what's happened in the US, and that is their population just aged. And it's been proven that we as consumers, we reach our peak spending years at about 47 years old. Now, affluent people, upper middle class, a lot of people that are making 150, 200,000, 300,000, whatever per year, they reach their peak spending years at about 55. So, by the way, in 2008, just before the meltdown, the average American baby boomer hit 47 years old. It was really no surprise that we had a recession. It was doomed to happen. Now, since then, we've had massive babies. Our babies are now getting older. They're not even near their peak spending years, and that's why I say whatever dip we have coming, and I do see a small recession coming sometime early 2022, maybe end of 2021, is going to be short, because what's happening is baby boomers were the biggest generation to ever walk the planet. Then we had babies, 2 each. So now you have this millennial generation that absolutely is going to dwarf the baby boomers when it comes to spending. So yes, we have some very good times coming, but they're going to build very slowly as these millennials begin to reach their peak spending years. It's only just happening at the very oldest millennial. Because you don't really begin those peak spending until you're about your mid 30s. It's ramping up every year from mid 20s. Okay, so why am I talking about inflation so much? Well, if the Fed thinks we're going to have inflation, the Fed's going to raise rates. But the problem is much deeper. The problem is that the Fed might think we're going to have inflation, and the only thing the Fed can do is raise short-term rates, the Fed funds rate. That's it. Fed funds rate will control the shortest end of the yield curve. For those of you that don't know, yield curve is simply if you take a 2-year bond and then you take a 30-year bond, every year the rate should be a little higher, right? The farther out you go, it should be higher. So in a normal environment, you have a nice gradually sloping yield curve. And the slope of the curve, believe it or not, is foretelling of where the economy is going most of the time. A very steep curve, when short-term rates are super low and high-term rate and long-term rates are super high, this is a curve that is suggesting inflation. It's suggesting potentially runaway growth. Why is that? Well, because the reason the rates got really low is the Fed pushed them here. And then the longer end, the Fed can't tell a 10-year bondholder what to do. I have to decide for myself as an investor. If I think inflation is going to come out and I think the Fed's wrong and he's pushing down these rates, I'm going to say, no, you're wrong. And I'm going to dump and dump and dump bonds. And all of a sudden, the 10 years going up and up and up, and the yield curve is getting really steep. A steep yield curve is the economy's way of telling the Fed, you got it wrong. And the long end of the curve is almost always right. Currently, I don't think they're right. And by the way, there's been so many times in history when they're wrong. And one of the easiest jobs I have in forecasting where I think things are going is just looking at the yield curve. And when I know it's too steep, well, I know that either the long end has to come down to meet the short end, because it can't be that steep. That's not sustainable. So the long end has to be pushed down, or the short end has to come up. But the Fed has to do the right thing here to get this side to do the right thing. And right now, this side thinks the Fed's a little bit too low down here. But if you really believed that we were going to have this kind of a huge uptick in inflation, well, the 10-year would be well over 2.5%, 3%. So I think the market's beginning to accept what I'm saying because we don't see rates going up. Now, then you want to look at a couple of things that are really driving inflation. Well, we look at the core rate of inflation. The core rate takes out food and energy because food and energy is thought to be too volatile to measure realistically. I understand, as a consumer, and you come home from the grocery store and you're like, wow, how can you tell me that we don't count food and energy? My gas prices just hit $5 a gallon in Beverly Hills and West LA. And I just paid, double for a pound of hamburger. What are you talking about? That is transient for sure. Those prices are affected by weather and all kinds of other things. Demand, of course. So we do take that out. But what we don't take out is rent and housing payments. And rent is going up and housing payments are going up. Affordability has been slipping because rates have ticked up a bit and home prices have gotten higher. And we're starting to see that in home prices. And that is ultimately starting to create a lag in the purchase market. You're seeing those MBA apps drop. But the MBA, a little bit worried because the index of the US price to rent ratio has gotten too high. And the last time it got this high, you can see this was just before the crash. Guys, I am doing the opposite of forecasting a crash here. What I am telling you is I think that housing prices will begin to soften. We track, if you want to do this yourself, you can go to Zillow stats or Zillow data. I'm not talking about their Zestimate that everybody hates, but the data that they produce is unbelievable, and they put it out there for free. So one of the things I've tracked for many years is the average listing price across the country, and in a fast growing market, the average listing price either stays flat or it goes up a tiny bit every single month. It does not pull back even one time It is the craziest thing ever. You go back to 90, every time you've seen a run in housing prices, you've seen the average listing price tick up just a little bit or stay flat, but it doesn't tick down even once. And what we found is when it does tick down once, it ticks down twice, 3 times, 4 times. When it reaches about the 5th month of a downtick, prices begin to fall. Not dramatically, but they can. And we're seeing that now. We just see third month in a row of listing prices just coming down tiny traces. And some markets more than others. Some markets are still going up, and you're thinking, what are you talking about? You're not supposed to come to these things on crack. But it's true. It's happening. It might not be happening in Orange County. It might not be happening in San Francisco County, but it's happening. And what starts in one part of the nation usually does come through. So believe it or not, the average listing price across the nation is worth watching. Rent prices are continuing to climb. Rent is a huge driver to what we're seeing right now in inflation. And guess what else? Oh, that's the next slide. I blew that one. It was so well timed. So this is an interesting slide because what you have here is the Fed's balance sheet. On the left, this is everything that they owned. Oh, I hate when I cut these slides off. Can I go back? Well, let me talk you through it.
Hey, Dan, real quick, just to reset, there's been a few people asked about these slides. Guys, they will be available to you guys after the call. They'll be in our file section of our Facebook group. So make sure you're aware of that file section. There's just a lot of gold to help you become more successful in that file section. So these slides will be there within an hour or two, and any edits Dan wants to make to the slides between now and then will get added to them. They are a gift from Dan to you to help you bring more value to agents and to upgrade some of your decks. But make sure you scan that. That file section is just full of gold. So look at some of the headlines, make sure you're aware of it. Anyways, keep it rocking, Dan.
All right. So this was the Fed balance sheet prior to the pandemic. This is the growth in the Fed's balance sheet since. So the Fed grew their balance sheet by 50% in about a year. This took a lifetime to get here. This took a year. By the way, this is not inflationary. This is deflationary. This creates a drag on the economy. Now, up here, this is the amount of treasuries they hold. I hate to do this, guys. It might be this one, but the point is the same. And I will fix this slide, and you'll have the right one. Let's pretend this one's treasuries. This was the percentage that was held of the Fed's balance sheet. This is the percentage since they've grown. And the point of the slide is they're not that worried about interest rates. I mean, they certainly have not been buying as many treasuries as they were before. Some months holding to their commitment of buying 80 billion, but for the most part, they haven't been. So they're not raising rates, but they're quietly saying it's okay if they trickle up just a little bit. And I think they're doing that more than anything just to calm down the market. I think the Fed is right. They should not be raising rates. So back to this whole, we're hungry and we're stuffing our faces, and someone in the back of the kitchen is cooking like mad. Well, the food is coming in ships, in major shipping containers. And again, food is just my metaphor. This is anything that we consume. Try buying a bicycle right now. Try buying a high-end bicycle right now, or buy a Trek. It doesn't matter. These bicycle makers are telling us as much as 12 to 18 months if we want to order a bicycle. It's insane. So we have these massive backlogs in shipping. If you live anywhere near a shipping port, just look outside and you'll see these ships backed up for miles. In Long Beach, I haven't looked in the last week, but I know in the last couple of weeks, you could see the ships as forever. So we're catching up, and this catch up is making everything look exaggerated. Our consumer now, I think, is about full. And I think you're going to see that maybe not in Thursday's CPI number, but in the coming weeks, you'll see that CPI has in fact peaked, and the producers are overdoing it. They don't realize that we're getting closer to peaking, and that's going to create a massive softening in price. I haven't talked to anyone at Goldman, but I believe that's Goldman's reasoning for seeing CPI and PCE, personal consumption expenditures, see them dipping in the end of 2021 because this game of catch-up is being exaggerated. So we know that June 10th is the big day. This is when CPI comes out. I won't read this to you, but there's a couple things when you get these slides. They're absolutely worth reading. And what you can see here is they're afraid that a sudden surge in CPI is not priced in by the market. So what that means is if there's a surprise, the market's currently looking for 0.8% of in CPI. That's a huge number. If it comes in higher than that, you're going to see bonds get under a ton of pressure, not long term, but short term. Just like last month when it came out, bonds tanked. Within a few days, it came back. Why? Because at first traders go, oh my gosh, this is terrible. And they dump, and then they come back and they think about it and they go, wait a minute, this is really transient inflation. And then they'll buy it back up. But just be prepared for that. One of the big inflationary things right now, and by the way, if you have a used car that you're on the fence about getting rid of, get rid of it, put it on the market. Used cars are up 50 to 60% since the pandemic. This whole supply chain problem has created this a massive backlog in used, not backlog, but lack of inventory in the used car market. That again is priced into CPI. These are big ticket items that between that and shelter, that's driving CPI quite a bit and very transient as well. So this is just another look at a similar slide. This is also Goldman. U.S. economy's team expects inflationary pressures to moderate in the coming quarters. This is key. If this happens, rates will soften for sure. These are the things that are driving inflation. You know, everything from used cars to shelter. And you can see that we are currently likely past the peak. The peak happened last quarter. It might actually be happening right now. But the point is, this might be as bad as it gets for inflation, and this might be as good as it gets. I think it already has been as good as it gets for the economy, which is why I'm super bullish on interest rates. There's pressure now coming from a lot of people in the housing industry that are feeling like, Fed, what are you doing? We have no inventory. We have housing prices going out of control. When you start talking about double-digit increases in housing prices, that's scary. That starts getting a little bit bubblish. And this says the MBA Association's average home purchase loan size hit 408. It's 21% above March of 2020's 336. Think about that. That's not normal. That's not sustainable. So, and yet the Fed, it's incredible how you track the purchasing of mortgage-backed securities to home prices. It's astronomical. But suddenly, guys, look here, mortgage application purchase index going down, prices going up. This is a dangerous divergence right here. You see how normally they really follow each other? So this is telling you that this is going to pull this down unless suddenly this spikes back up. Obviously, I hope this spikes back up. Probably what happens is we meet somewhere in the middle. So, and I don't think the Fed's in a position where they'll back off on these MBS. They could, and if they did, they'd probably start putting more of that money into treasuries. And look at things like there's so many of these types of slides. I just don't have time to go through 100 of them. But look at the writing just in the New York City subway. It's 37% of norm for this time of year. Yeah, I guess people are still afraid that, you know, they don't want to get on a subway because of the pandemic. But you look around in the metropolitan areas where we don't have to use mass transportation, the freeways are crowded. Traffic's as bad as ever, as I'm concerned. But for some reason, not everybody is leading this normal life yet. And so I don't believe the economy can fully get back to normal until I see it, you know, in every regard. I don't know when that's going to happen. This talks about the consumer's savings rate. You can see here it goes up and up and up since the pandemic. I'll tell you, this part here in the beginning had a lot to do with just fear and people hanging on to their money. And then it became too much stimulus. Then the Fed funded people's savings accounts and it reached a very, very high level. And then that's forecasted to begin dropping. So people are not, as the saving rates go down, it could be good for the economy, but it also tells you that this whole increase in savings is not because people are making a whole bunch of money. As savings goes down, it could also be people are dipping into their savings. And this is why I think that this, we've seen the best. This spaghetti looking stuff here on the left, this is Westpac, Citi, and Bloomberg's surprise index. And when it's up, it's telling you that all the economic information coming out was a positive surprise. So you can see as the pandemic came out, literally every piece of news was bad. And then every piece of news was amazing. And now it's just falling. This is a strong downtrend in economic surprises. And here it is just alone, how much the economics, this is cities alone. And also notice how the stock market follows economic surprises. And it's kind of weird that the S&P keeps going up while the economic surprises are going down. This should tell you there's probably a correction coming in the stock market. Another just concern about the economy. And the reason I'm sharing these concerns again, this whole point is about why I don't believe there's going to be inflation and why I don't believe the economy is as strong as many people think. And because of those two beliefs, why I strongly believe interest rates are going to drop. So this is 35% of small businesses are risking closure by the end of August. Yikes. Believe it or not, a lot of them are saying, because I can't hire people. What are we going to do to get people to want to come back to work? This tells you of the small businesses that think they're going to fail, what sort of sectors it's coming from. Retailers, health and wellness, restaurants. No big surprise to me. This is probably one of the most important slides of the day. This is actual employment versus continuation of pre-employment. And it's showing you that there's a 10 million jobs short right now. So let me explain this. This is where we were just before the pandemic, this blue line up here. And based on that trend we were on, this is where we should have been going. This is where the pandemic took us. This is where we are now. We're a long ways from normal, guys. And it's not that there aren't jobs, it's that there's not people that are willing to take the jobs. But I don't care. Either one of those is potentially bad for the economy, because remember, consumption, 70% of the economy. We cannot produce what we cannot consume what we cannot produce, and we can't produce stuff without people showing up to work.
Hey,
Dave, you want to?
I do. Could you stop sharing the screen real quick? I want to make a point and give everyone who's watching this a suggestion. So when you have a man like Dan who's prepared to get on a stage like this and walk you through 20 to 25 slides, he's educating you so that you can be a mortgage professional. You can understand things in a deeper way that a consumer needs to understand things, deeper than a realtor needs to understand things. But anytime you're doing this, hopefully you're listening, you're studying, you're learning. And if there's something you didn't understand, for all you new people out there, go back, make sure you understand it. Make sure you get your questions answered, participate in our group. But when Dan says something like, guys, this is going to be an important slide, that means, okay, pause. And I just looked at that slide. That's a slide you probably want to add to your consumer deck. That's a slide that you might want to put on social media and put your content around that. So, and I'm not saying that is the slide because I haven't gone through the whole presentation, but I just want to make sure that as a mortgage professional, you should be like, okay, I'm at school here to learn. And then I want to make sure you're like, and I want to take something that I learned today and I want to put that on social media. I want to integrate that into my conversation. And probably there's not going to be more than 3 things. Like there's not going to be more than 3 slides that you want to share with your customers, but there's going to be 2 or 3. So Dan, I want to bring that back to you because you're a teacher and a leader and you put this together. Is this one of those slides that you think loan officers should add to their deck and create content around, or are there going to be other slides coming that you think are hey, this is the one?
Yeah. So Dave, I think that's a great question. And yes, I do think this is one, but not the. To me, hopefully, if you can digest pretty much the package here. Okay, what are the points he's making? He's making points that he thinks inflation has peaked. He's making points that the economy might be weakening, and he's making comments that housing prices might soften a little bit. And what does that all add up to? That adds up to lower interest rates. And so that this whole deck, I would love you to be able to take this, maybe consolidate it if you want, and do exactly what I'm doing for 20, 50, 100 realtors. And I'll tell you what, you get enough realtors, I'll do it with you. I'll sit in the background.
Ooh.
You can interview me. You can, however you want to do this. But my whole goal in life here is to try to make the information digestible so that you can, as Dave said, you use it. Every time I'm reading something, every time I'm learning something, every time I'm listening to somebody, in my head, I'm going, how can I repurpose this? How can I take this and help my members? And that's what you should be thinking. Every word you hear from me or anybody else that you respect, how can you take that and help your consumers?
So a couple other questions that have come in. Dan, someone had asked for a link to that Zillow information you offered earlier. Are you willing to share that in comments later on? Find the link and put
Sure.
it in the comments. Okay, we'll get that for you. Great question. Where do you see? Well, Brian, we'll save your question. I want to go through Dan's presentation. He might ask it. And then Brendan Bracken, good to see you, brother. He said, this is a fantastic continuing education. Can we get this as required CE? Crushing it, Dan. So first of all, thank you for the comment. I'm afraid that creating CE content is, no, we're not going to try to do that. We're going to just give you continuing education to make this qualified as CE content. Any comments on that, Dan?
I would say that anybody that has the ambition should go out and do that. You can go out and get this CE approved. I'll help you turn it into a course. I think that'd be powerful. So it's not something I really have the time to go out and get CE approved, but from what I understand, it's not that difficult.
Yeah. Well, I thought of it and I'm like, I don't want to do that. That's not mortgage coaches thing. Maybe we can get Ken Perry. Maybe we can do Dan and a Ken Perry collaboration, and Ken can get it approved and Dan can speak. So someone tag Ken Perry and say, hey, Ken, we'd love to have some CE Dan Keller content out there. So let's keep it rocking. We got 23 minutes left, Dan. So hopefully we can get through your whole deck.
Yep. All right.
I'll tell you what I see.
And I'm not much farther. I do want to spend time talking about some technical analysis, looking at charts with you and showing you what I look at when I look at a chart. I think that'll be helpful for you. So we're well, there we go. That was the last slide. So what I'd like to do here, one, we can answer some more questions, or two, I can talk about some of the ways that I use my analysis to help you understand where rates are going. Because I think people find that interesting and it's my greatest passion. So why don't I do that? But Dave, if you get questions and you want to interrupt me, or you want to start there?
Knowing that we're through the call to economic slides, let's get a question from Brian here answered. If maybe you could stop sharing the screen one more time. And remember, guys, put your questions in. Like if you were new and you didn't understand the concept, we've got 20 minutes. So we could go back to a slide. Dan could give you a little more education. Put your questions below, whatever medium you're in. So Brian Hartley said, where do you see home prices and appreciation, moving forward, assuming no inflation? Are they likely to still stay above average of appreciation given the inventory constraints in most markets?
No, I think that, again, inventory it's so imperceptible. You have to squint, but inventory is growing in many markets across the country. And nationally, the average inventory now, I might butcher this, but it's the idea is very accurate. Let's say the average time to sale was 18 days. It's now 21 days. It's slowly sneaking up. Look at your purchase apps, guys. Again, you see what's happening. The price is just hitting a pain point just now where the consumer's saying it's too much. So I think that for certain, I don't think we're going to see continued above average appreciation. I think we're going to see below average appreciation and maybe tads of depreciation some places, but tads. And this is where I think you just could really dominate your competition. One, be honest enough to admit that this might be coming, assuming you agree with it. I'll give you enough data that I think I can make you agree with it, but then be able to take Mortgage Coach and say, oh yeah, prices might drop 10%. You might save $80,000 on your home, which I don't think it's going to be anywhere near 10%. But let's look at what happens if interest rates go from 3 to 4.5, 4.5 is nothing. That's where we were before the pandemic. You'll eat up that savings so fast it'll make your head spin. So that's where the the cost of waiting analysis comes in very, very key. And then the last thing, and I post content like this all the time for our members. Home ownership is so much more about appreciation. You know, it's to me, it's appreciation should be the least important thing. Home ownership does build wealth. It builds wealth, 3-4% appreciation a year, paying down your mortgage every year. Homeowners are more wealthy than not homeowners. That's been proven. I've shared a lot of slides like that. But I think that people want to buy a home. They want to be able to fix it up. I shared this. I was on a call with Ryan Grant with the Art of Home Ownership. And, you know, I talked about the intangible benefits of home ownership. And we rented after the meltdown. We sold our house very near the top. We knew that the top was there because housing affordability had hit a multi-year low. Prices were ridiculous. And it seemed to me it wasn't sustainable. We sold our house. We decided to rent just until what I thought would be a pullback was over. I didn't realize the pullback was going to be, 3 or 4 years, which essentially is what it was. So we rented for that period of time, and we rented in a super nice neighborhood in Corona del Mar, right near the beach. And I justified myself for those years that, yeah, I'm paying $5,000 a month for rent, but if I bought a house in this neighborhood, my house payment would be $7,000, and I would be tying up, $700,000 of capital. And I thought that was true. I really believed it. And then finally, Sophia and I decided to buy a home. And from the day that happened, I realized how much we had missed. She was out in the garden. She was fixing things up. She was painting stuff. She was wanting to buy furniture. By the way, all those things drive the economy. And I realized just how empty we had felt as renters. And that's, I think most homeowners want that. They want that feeling of having something. So
Dan, that makes me think of a follow-up to this. Let's do a call next month, July, no later than August, where we do a rent versus own. We invite a mortgage coach, maybe Scott Nicholson or some other loan officer that knows how to do a cost of waiting, knows how to do a rent versus own, and you provide a combination of stats and facts that make the case for homeownership. Some of those financials, some of those, I don't know, whatever you put the word around it, emotional issues. And we teach how to use a TCA to have this conversation and how to use content and slides. What are your thoughts? Are you game for putting that on the calendar?
I'd love it. Yeah, I'd love it.
So guys, if you want us to do that, let us know in comments. That we would love Dan to do that. If there's a particular loan officer that's a mortgage coach, they've got to be a grandmaster who's done over 1,000 TCAs. Let me know who that is. If you're that loan officer, you're like, Dave, I want to share a slide. Maybe we'll get a couple loan officers on it. Maybe we'll have Dan and a loan officer, and then we'll have a couple guest TCAs. So Sean Murphy just asked, we have seen offer prices over ask price at 300,000 on a regular basis, obviously in a high-end market, even up to 2 million. So really high-end market. Clearly, the position they want a home and to win. Any comments on this now and the phenomena moving forward? I mean, I think Dan just gave that, but Dan, anything you want to add to that? Because I think you kind of answered the question, but let me know if you have more to add.
Well, let me quote Warren Buffett: "Whatever cannot continue must end." Is it possible that this continues? It's not possible. It doesn't even compute in anyone's mind that you can have this type of a frenzy in buying as sustainable. It never has been. We've had periods like this before. So, and I think that if you start looking at what was happening 2 months ago, last month, and next month, you're going to see that that's already softening a little bit. And granted, you might be in one of those markets that it won't happen, but we're seeing a national trend here.
Cool. Well, let's finish.
Slow.
Well, Dan, let's completely finish up your slides, the presentation. Also want to make sure people know who want to, go deeper with Dan and become part of your mortgage mentorship tribe, how to do that. And then guys, if you do have more questions, we will get to them by the end. And remember, the slides will be available in the file section. So why don't you put your slides back up and let's rock it out.
All right, you got it. Yeah, and I have a class at 10, so I got to make sure I'm I'm ready to go here. Okay, so what I wanted to do real quickly is bring up a couple charts and just give you an idea of what we look at. And in fact, I have some decent examples recently of trades we did. Okay, let me get this nice and big. Get rid of that. So let's bring up the 10-year bond chart. Where the heck did it go? Oh, there it is. First thing I want to point out, I think you'll find this fascinating, but you see this gold line going across the page here. Oh, that way, that's a 5-minute chart, but that's okay. It's still important. This gold line is what we call the point of control. And all of these silver line, these bars going across, these are volume bars. So this is telling you the volume that's been done at a certain price. And so what we know by looking at this gold line is there has been more volume done at 132 and 12/30 seconds on the 10-year than any other price. And because of that fact, obviously more people own it and more people have shorted it. It becomes an emotional battleground. And you have to consider there's always a battle between the longs and the shorts. And that battle is actually more relevant than a battle between buyers and sellers. Well, shorts are sellers. And just to quickly share with you the concept of a short, if let's say that there's a stock, ABC stock at $10, and I don't think it's worth more than $5. And I have very strong reasons why I believe that. I don't own it, but I want to short it. So I go to my broker and I say, I want to short ABC. And he says, fine, I'll get you the shares. He lends me the shares. Let's say he lends me 1,000 shares. I have to pay back 1,000 shares, not any price, but just 1,000 shares. So I now have 1,000 borrowed shares in my hands at $10 a share. I dump those things because I think it's going down. And I want it to go down to $5. And when it goes down to $5, I'm going to buy those shares. And then I'm going to repay the guy that I owe the 1,000 shares to. So I sold at 10. I bought him back at 5. I made $5 a share. And then I paid back those shares. What happens if I borrow shares at 10? I think the stock, it goes to 15. I'm sort of hosed. I've got to run back into the market and try to buy them back as fast as I can. And the more I try to buy them back and every other short seller is trying to buy them back at the same time, that's called a short squeeze. And all of a sudden the price just flies. This is what a short squeeze looks like here. When you see these parabolic rises in bonds, that's a 5-minute chart. But when we get around this level, I become very interested because this is a deciding level. This is, the buyers are all going to try to protect this line. As price starts slipping, they're going to say, oh, no, we can't let it slip. Why? Well, when I worked at Bear Stearns, let's say I was trading, $100 million a day. And let's say I took a $50 million position right here at this price, and I start seeing it slip and volumes may be light. I'm like, two things. One, I'm going to buy more, but mainly I want to look good to my boss at the end of the day. I need to keep the price up. So I'm going to defend the line. The short sellers, same thing, especially these hedge funds. They shorted it. They want to report something good at the end of the day to their investors. So as soon as they start seeing it drop, they heavily start selling more because they know when it gets below here, it could really fall hard. And so you'll tend to see price linger at the point of control until it doesn't. And when it doesn't, you see these astronomical moves. So here, and this is not normal, let me make this bigger. This is the 1-day chart. And you can see that the bonds have been, the 10-year has been very much range bound since March 24th. And the more it stays in this range, the more people are buying and selling. And every time one of these bars is created by a bunch of people that either made money or lost money at this level. So you have a whole bunch of people, every time it hits this level, they're going to buy more, they're going to sell more. Maybe they bought here, it ran all the way down here. They panicked. As soon as it got back here, they dumped it. So this becomes almost magnetic. And that's why when things break out, they break really big. I'll show you a couple examples in a minute. So right now, the more we're range bound, the more we're range bound and we're stuck. And this point of control has been key for a long time. At some point, someone's going to lose this battle. and you're going to see a spike that you cannot believe. And if you use these gray bars, what you'll know is we're stuck. Think of these as magnets. Also think of them as shelves, and then think of them as launching pads, because they're all of that. And when we get above here and we've gotten above the point of control, now we get to launch off this volume because there's no shelf above us to stop us. Whereas down here, we tried to run up, we kept hitting our heads on, there's so many shelves to bump our heads on. We're still bumping our head every day. But as soon as we get above these shelves, up we go. So I am looking for a move like that. And I think it's going to come fairly soon, but we got to get through CPI first.
So Dan, I want to make sure, folks, you get the Rate Watch. If you're a Mortgage Coach member and you have access to the Advice Engine, you also have access to our Rate Watch app, which includes a daily update from Dan. But I want to make sure everybody knows about Market Mentor, because Market Mentor is for folks that want to go deeper. Like, they really want to have you as a resource. They want to, I know you have a chat where they can communicate with you literally on a daily basis. I know you do that quick down and dirty update for us. And then I know you do an update in that. And then I also know you give people social media content and things that they can promote. So tell everybody about Mortgage Mentor before we run out of time. And then guys, we'll do any last minute questions that you have.
Got it. Okay. Let me show you some slides real quick. And by the way, these slides will also be helpful because they'll help sort of close the loop on some of these technical points I wanted to make. Where's my slides? There we go. Okay, I'm already sharing. Yes.
We see them.
So the whole idea with Market Mentor is to have you be the mentor. I want to literally do a mind meld with you and share with you and give you the things that I've spent my life's work knowing and understanding. And I think you'll find that gives you more confidence when you're selling, because you're always going to get that consumer that has that question and you find yourself hemming and hawing around it. And you don't want to do that. You don't want the next guy they talk to be really confident in talking about the economy and talking about home prices. And by the way, never beating your opinion into their brains, but sharing your opinion openly and giving the why behind it. And then what I always love doing is say, by the way, what do you think? And that stimulates some of the most interesting conversations. It completely gets you off any discussions about rate. And when you have this power, this knowledge, it does become your brand, and it's worth more than anything. In my opinion, it's kind of really all we have as salespeople. So, the questions you want to ask yourself is, can you predict the movement of interest rates with just a glance? I can. Can you determine the macro direction of home prices without recalling, on the industry experts? I can. Can you effectively interpret the waves of market data being released every day? I can, because I've been doing it for years. And my whole idea is to teach you how to do this. So what you get is 2 live updates. So every morning usually around between 8:30 and 9:30 a.m. I want the market to open. I want people to kind of get a feel for their day. I go on and I do a live update for our members. And during that time, they can ask questions. We talk about the market. I think it's helpful to these guys. And then we do the same thing near the close, between 1 and 2. So you can really make that last minute lock decision. But the main thing, sure, locking is important. The main thing is filling your brain every day with talking points so that the next phone call you have something to talk about with people. This, I believe, is the cream, sort of the whipped cream on top. And that is, I share stock information. I do a weekly video. It goes out every Sunday night. It talks about the economy. It talks about what happened last week, what I think is going to happen next week, how that's affected the markets, both bonds and stocks. And then I show you the stocks that I'm watching for that week. And the win rate is pretty darn good. I'll show you some examples. And then you get our Market Mentor training, which includes content, how to read charts, all that good stuff. So a couple quick just things. And so this was beyond. I put out this alert to our members. I said I normally don't bottom fish, but when I do, I choose beyond. And I shared a chart as to why I thought the stock was going to really pop and why I thought I'd hit bottom. And just days later, the stock went from 131 to 160. If you bought call options, which I teach you how to do, you would have made a whole lot of money. Our biggest trade of the year still is space. On January 13th, I announced that I was buying space. Here it is. Going to buy some calls. I'm buying the February 35 calls for 155. We sold these calls. How many days later? Sorry. 10 days later, I sold these calls that I bought, spent 150 each. I sold them for $6.50. It's a pretty big return, like 500% in 10 days. Then yesterday, I had a member ask me about Bitcoin. And there's a lot of these people that are thinking that Bitcoin has hit bottom. So first, this member came out and asked me, this was May 28th, somewhere in here, what do I think about Bitcoin? And I told him, I don't think the selling's over. We barely touched the support. I gave him all these very strong technical reasons. And then I proceeded to draw the pattern in which I thought Bitcoin would follow. And it's almost perfectly followed it, by the way. I haven't checked this morning, but I think that we're going to take out, we already took out this low. And one of the things we look at is look at Bitcoin dropped, made a low. Then it tried to come back up and it made a lower high. This is when I knew the party was over. Came all the way down, took out this low. Feeble attempt, lower high. Dropped again, took out this low. Feeble attempt, failed again to make a high. Comes out, makes another low. I think the next move is another lower high, and then I think the wheels fall off down into the mid-20s. That's what it's looking like right now. I also shared with them a bullish point of view that if we didn't take out this low, what would happen? So in closing, you'll get my 2-minute method for determining the direction of rates. You'll know when big investors are dumping stocks. You'll anticipate the Fed movements. You'll learn to predict and avoid economic catastrophes. We call them black swan events. You can't really predict a black swan event, but you can know how to tell when one's coming and how to extract immediate and useful data from the economic releases. So all that is a whopping $24 a month, and it's month to month. You can cancel anytime you want. And you know, in all modesty aside, I just think for the data that I'm sharing for $24 a month, it's kind of dumb not to do it. Oh, one more thing. If you're not a Mortgage Coach member, and you should be, but if you're not, you also get the Rawitch app for free. And I think that's one of the best live bond market update apps out there. That's all I got.
Got it, guys. So we'll put a link down below, whether you're watching on YouTube. Dan, if you could stop sharing your screen. By the way, the Rawitch app is not one of the best. It is the best.
Sorry.
App. And
Shame on me.
It's consumer friendly. You can share it with a family, and we designed it for families. So guys, if you're not using the Rawitch app, you're a Mortgage Coach member, you haven't downloaded it, you're missing on the best MBS app on planet Earth. And it's easy to share with consumers. We even make it so, like, let's say you quoted rates and rates got worse. You could go back to that day, go to the daily update, and you can like, hey, rates went up. See? So you can do on the offense. What do you think they're going to do? You can do it on the defense, and pure value, guys. So make sure you have the app. Guys, if you've gotten value from Dan Rawitch, you know, invest in his platform, check it out, be active. He loves helping you guys. Dan, it's cool to see how you've evolved it. You know, great job on just that extra level of, you want to be a mentor like Dan, get in there. But thank you, brother. So we are at the top of the hour. Any closing thoughts you have for everyone? Any like last words of wisdom for the Mortgage Coach community before we wrap this up?
Yeah, just again, your knowledge is your net worth, and the guy that gets smarter than you is going to get richer than you. This is a universe of immediate information. People need to know now, and they need to be able to trust you. And when you can talk about this stuff with conviction, I think that you will gain market share.
Guys, I want to close with my closing word and play off of Dan's. Your knowledge is your net worth. The only thing I would want to say to that is the knowledge that you've taken action on is your net worth. So, guys, take action, make notes from this, pick a slide at a minimum that you want to create some content around. At a maximum, become a market mentor. Like, learn how to give a presentation like this to a group of realtors and take action. Connect with Dan, marketmentorship.com, link down below. Dan Rawitch, you're the man, brother. I can't wait to see you in the real world. And
likewise, buddy.
Yeah. And everybody who tuned into this, got value from this, we appreciate your time and your trust. Have a great day, everyone.
Yep.
This is a
Thanks.
wrap.
Bye, everybody. Take care.